Welcome to the Enterprise Blockchain Review powered by Fifth-9. On the podcast today, we'll be discussing digital asset tokenization, evolution or revolution. Today we'll be joined by Barry James, founding chair at the British Blockchain and Frontier Technologies Association, host of ICORadio and CEO of the Crowdfunding Centre, Yakeen Prabdial, managing director at Fifth-9, and Mark Kirby, co-founder and CEO at Coincierge. Since our last podcast, there have been some major developments happening in blockchain and tokenization. We see big players are entering the market. Facebook will soon launch their own token called Facecoin, JP Morgan developing their own stablecoin, and Microsoft building its own decentralized identity foundation. We've also witnessed the tokenization of real-world assets gaining traction. JP Morgan has announced that they will be tokenizing gold. Token Oro will soon be unveiling its preferred security token to the market. And Iran's biggest banks have joined forces towards a vision of tokenizing assets on a private blockchain. Mark, any thoughts on the news?
From my perspective, it's quite interesting to see some of the bigger players coming into the market, which is, I think, good for awareness and good to see that there's entities that people look at and trust. I think that if tokens are mentioned, if blockchain's mentioned, then I think it gives a little bit of comfort, really, to the global market. However, what I would say is something that I find quite interesting to be looking at is how does this become mainstream, and how does your JP Morgans of this world create a token that is viable for a global market and viable for the likes of HSBC to be involved with, some of the other big five. Now, most probably they want everything to themselves. So this again is an area which I'm focusing on in terms of tokenization standards and how it becomes a global outfit rather than just individuals doing their own thing.
Mark, I think your position on JP Morgan is a valid one. It's interesting that the traditional, no matter how obscure and esoteric people view blockchain and cryptocurrencies to be, it seems to be following the same hype cycle where 3 years ago we saw it as immature, early, disruptive technology player. And now we're seeing that big, well-founded, branded names which have made their fortunes on traditional legacy models are now looking towards either the blockchain technology as a distributed business instrument of trust or as stablecoin, which is what JP Morgan and others are looking at. So it's very interesting that the market dynamics of maturity are starting to show, and by definition gaining a lot of market confidence in the blockchain movement as a whole.
Yeah, actually, we're at a very interesting and probably a very important point in history, in my view. We've seen all of these big names begin to either declare or show sign of, activity, clearly in a way that's been thought through and long planned. I think what we're seeing is, within the crypto sphere, there's been a feeling that it's almost separate from the rest of the world, and we're seeing things coming together. But we're seeing people like Microsoft coming in and wanting to own territory. And I understand that they're plugging into open standards and that sort of thing. That's great. But actually, when we see these things happening, particularly against the backdrop of some of the things that are happening in regulation, it's going to be really interesting to see how this lays out in terms of the technology being absorbed into existing business models and centralized business models as opposed to decentralized, and what mass adoption is going to mean in this scenario.
I think that it's super interesting to understand, first of all, what exactly does tokenization mean in this new blockchain economy? I mean, previously, fractionalization was well understood as time sharing of homes. But what exactly does tokenization bring that is different from traditional fractionalization?
Well, perhaps I could comment on that. So blockchain-based fractionalization has great promise. So there's been kind of quite a lot of arguments. I'm sure listeners will have heard some of them raging about, well, this blockchain stuff, it's just a really slow database and doesn't bring very much at all. The idea that there's nothing that you can do or very little that you can do that you couldn't do before. Well, obviously, when you kind of start to analyze those arguments, they're spurious. Certainly, you couldn't solve the double spending problem. And there's then a whole raft of things around immutability and so on. But actually, what really matters is what you can do practically. With this technology, you can create infrastructure practically that's secure and that doesn't cost billions to put into place. When you kind of start to look at fractionalization, Yes, in principle, it was doable before, but in practice, not really, not very much, and quite a high cost. So the difference, it seems to me, is going to be the range of things that can be fractionalized, the fluidity with which they can be fractionalized and moved around and so on, and the cost involved in that. Yes, if you were to throw many, many millions at each of these things, maybe they could have been done before, but not practically.
Yeah, I totally agree with your point there, Barry. I think that also it's liquidity. I think liquidity is probably the biggest play in the market at the moment. I think Deloitte's published an article stating that potentially through tokenization, there's a possibility to unlock like trillions of dollars of euros in current illiquid assets. And I think that through fractionalizing assets opens up a huge marketplace for asset managers and family offices. And also it opens up a huge opportunity for, maybe sophisticated investors, but also retail investors to be able to invest their money into assets which are producing nice returns or better returns than they're sitting in the bank.
Yeah, I think, Mark, that's a really good point, that prior to blockchain, fractionalization of assets was pretty much limited to either large components of value being moved across. And also, it was a lumpy, high-friction process, which, as you quite rightly said, didn't allow for any form of investor, from a bedroom investor to the big financial institutions, to take advantage of these new asset classes. So I think that's a very valuable point. What I wanted to ask is, do we really think that tokenization is the new killer app for blockchain?
Simple answer, yes, but there's a longer answer. And the longer answer is that blockchain isn't really about apps. Blockchain is about infrastructure. And in the same way as, I was in boardrooms a good few years ago, late 90s or whatever, trying to convince people that the web was worth adopting and so on, and would be asked, well, what's the killer app? To kind of ask that, it pretty much misses the point, in the sense that it's actually infrastructure. It's actually a change to our environment. And look at the change that's happened to our environment since the late 90s. We live in a different way. We work in a different way. And that's the level of change we're talking about and more. Having said all of that, my view is that the potential of tokenization is pervasive. It can change a wide range of things. It can make things more affordable, can allow people to participate and to fund things in ways that were never possible before. Actually, the fact that we kind of think of it as a secondary market, the fluidity, when that kind of comes into play, we know what kind of difference and what kind of power that can have. If it was just about fractionalization, it probably would be a kind of killer app, but it's more than that.
Mark, I think we'd be very keen to understand what Coincierge.io has been doing in this tokenization space. If you can give us a bit of a position on how does it work and what movements you guys have seen in 2019 in respect to tokenization of assets.
So Coincierge is a tech company focused on reducing compliance costs, complexity, looking at applying blockchain technology with an open source frame of mind that allows tokenization to become a reality. We've created and self-built a protocol called Coincierge Protocol. And the protocol has two identities. One is an open source protocol for developers to use. Second thing is a SaaS platform that implements the Coincierge protocol without obviously having to write any code. The protocol that we've built is a constellation of smart contracts that makes fully automated on-chain compliance possible. Now, bearing in mind that there's multiple platforms available to the marketplace at the moment that do the token security issuance. Now, that's fine. They're being successful at the moment. But from what I said earlier on in terms of a token standard, there's no token standard being put in place at the moment. Now, the reason why we built our protocol is that not only in the primary market, but secondary market, which is going to be, I would say, probably the biggest growth area over the next 12 to 18 months. But I am still waiting to see something which allows the secondary market to have these compliant checks in place. And this is the issue, that this allows us to be able to secure the compliance part from the original investment. It allows the exchanges to use our open source technology to be able to implement these compatibilities within their exchanges, and it allows there to be some sort of token standard throughout, which also meets compliance and regulations of multiple jurisdictions.
On that subject of tokenization, I think, Mark, we're super interested to see how this secondary market starts to unfold, specifically when people start to recognize the value of liquidity in digital assets. Barry, I think we're super interested to see if this tokenization of digital assets will impact ICOs, whether they will drive a new world of STOs based on a Picasso coin, or will tokenization actually crowd out the crowdfunding world?
Obviously, the STO side of things it's been decimated over the last year, to be frank. It's probably between 10 and 20% of what it was. The big move to STOs is going to be harder, and is proving to be harder than people thought. On a side note, Indiegogo have recently acquired of equity crowdfunding because they've found it so difficult. That is an indicator. So actually, STOs have been painted as the great white hope of moving forward, but they are of necessity regulated and therefore parochial in the sense of being not global, national. So tokenization is a kind of dimension in that. I think tokenization has been part of ICOs and will be part of STOs. And we'll see that continue.
We're super interested to understand from the fundraising perspective of how tokenization can start to act upon the building of intangible assets. Both you and Mark are well aware of our Sparks protocol, and that model of being able to create tokens on an intangible asset and watch it grow, I think, is something that we're keen to push forward, and very keen on how this will participate well with the crowdfunding and ICO markets.
I think the ICO market was certainly an interesting one. There were some good things that come out of it, and I think we're seeing the benefits of that now in terms of certain jurisdictions looking at this in depth and starting to create a regulatory standard. But I think that purely looking at the securities market, it's going back to what we were talking about in terms of fractional ownership, tokenization. At the moment, I think that there's a lot of things happening. I think in terms of tokenization of assets, it is leaps and bounds ahead from where it was even December, January time beginning of this year. Because I think there's more serious players in the market now. People that have come to the market who have been watching this space probably from the back of the room. And they're now coming into the market saying, actually, there are possibilities to create new markets within different asset classes. And okay, everyone looks at real estate being the main one. Yes, get that. There's others where there's companies that are holding portfolios of super yachts, for instance, or charter jets. I think that from them kind of assets, there is no liquidity. There's no real vision in terms of returns from actually physically owning them assets. However, fractional ownership, yes, because I think that there's a possibility to gain a yield on that investment that you're probably not going to get from any kind of traditional methods at the moment. We probably never could do in terms of liquidity. Depending on where you're looking at this from a land registry perspective, I think that there's huge opportunities in real estate. I think there's a lot of difficulties in the real estate because there's so many different complexities that are involved that you've got to try and get on chain and try and